The Great Canadian Reroute Diversifying Energy Horizons. Canada stands at a significant energy crossroads. For decades, its vast oil reserves found a primary market south of its border. The United States was the undisputed destination for Canadian crude. However, the global energy map is constantly being redrawn. New pressures and emerging opportunities are compelling Ottawa to rethink this singular focus. The nation is now actively seeking to diversify its energy export destinations. This marks a fundamental shift in Canada's approach to its energy wealth. The ambition to reduce reliance on the U.S. market is a calculated response to evolving geopolitical and economic realities. Canadian policymakers recognize the inherent risks of depending too heavily on one customer. Market dynamics can change and political climates can shift. A more diversified portfolio of buyers offers greater resilience and economic security. Asia, with its growing economies and immense appetite for energy, presents a compelling alternative. Liquefied natural gas, or LNG, is emerging as a key component of this new strategy. Canada possesses abundant natural gas reserves, particularly in its western provinces. Developing the capacity to liquefy this gas and ship it to Asian markets is now a national priority. This eastward gaze represents a significant undertaking, requiring new infrastructure, new partnerships, and a new mindset. The goal is to transform Canada from a price taker in a captive market to a more influential player on the global energy stage. The perils of a single basket: economic and political vulnerabilities. Relying predominantly on a single export market, even one as large and historically stable as the United States, carries inherent economic vulnerabilities. Canadian energy producers have often found themselves subject to the specific demand fluctuations and pricing dynamics of the U.S. market. When U.S. domestic production surged, Canadian oil faced increased competition and downward price pressure. This lack of market diversification meant that Canada had limited leverage. It could not easily redirect its exports to other regions where demand might be stronger or prices more favorable. The political risks associated with this over-reliance have also become increasingly apparent. Changes in U.S. administrations can bring shifts in energy priorities, trade policies, and infrastructure approvals. The Keystone XL pipeline saga serves as a stark example. Years of investment and political capital were expended on a project that ultimately faced rejection due to U.S. domestic political considerations. This highlighted how Canadian energy projects could be derailed by political decisions beyond its direct control. Furthermore, this singular focus limited Canada's ability to fully capitalize on global energy trends. As demand for energy, particularly cleaner forms like LNG, surged in Asia and Europe, Canada was not optimally positioned to respond. The economic cost of this missed potential has been substantial, prompting a re-evaluation of its long-term strategic interests in the global energy landscape. The imperative to build new coastal export terminals, particularly for LNG, became a clear strategic goal. This would allow Canada to access global pricing and diversify its customer base, thereby mitigating both economic and political risks. The tariff tipping point: U.S. policies as a catalyst for change. Recent U.S. trade actions accelerated Canada's resolve to diversify its energy export markets. The imposition of U.S. tariffs on Canadian goods sent a clear signal. These measures created uncertainty and underscored the risks of overdependence. Canada needed to cultivate alternative economic relationships. The impact was immediate and palpable within Canada. This translated into renewed impetus for projects like the Trans Mountain Pipeline expansion. This period of trade friction accelerated the strategic shift towards Asia. Gazing eastward, Canada's LNG aspirations in Asia. Canada's strategy to tap into Asian markets is heavily centered on liquefied natural gas, or LNG. The vast, rapidly growing economies of Asia, including Japan, South Korea, China, and India, have a significant and increasing demand for cleaner-burning fuels. Canada, with its abundant natural gas reserves in British Columbia and Alberta, is geographically well-positioned to supply this burgeoning market. The shorter shipping distances from Canada's Pacific coast to North Asia offer a distinct logistical advantage. The Canadian government and energy industry are making substantial investments to realize this Asian opportunity. This involves the development of large-scale LNG export terminals on the British Columbia coast. Projects like LNG Canada represent a multi-billion-dollar commitment to transforming Canada into a significant global LNG player. This strategy is not merely about exporting a commodity, it is about forging long-term energy partnerships with Asian nations. British Columbia's coastal gateway powering the Pacific pivot. British Columbia, or BC, is central to Canada's new energy strategy, serving as the primary gateway for LNG exports to Asian markets. The province's Pacific coastline offers the most direct shipping routes to countries like Japan, South Korea, and China. Major infrastructure projects, most notably the LNG Canada facility in Kitimat, are transforming BCS's industrial landscape. This massive undertaking involves not just the liquefaction plant itself, but also extensive pipeline networks, such as the Coastal GasLink pipeline. The environmental credentials of Canadian LNG, particularly from BC, are a significant aspect of this strategy. Proponents highlight that Canadian natural gas often has lower upstream emissions. Moreover, BCS's abundant hydroelectric power offers the potential for LNG facilities to operate with a much smaller carbon footprint. The development of BC's LNG industry is also intended to stimulate economic growth within the province and across Canada. Navigating the headwinds. Challenges on Canada's new energy path. Canada's ambitious energy pivot, while promising, faces a complex array of challenges that could impede its progress. Economic uncertainty looms large in the global energy markets. Fluctuating commodity prices, particularly for oil and natural gas, can significantly impact the profitability and viability of large-scale infrastructure projects. Securing long-term contracts with Asian buyers at favorable terms is crucial, yet the LNG market is increasingly competitive. Infrastructure constraints present another significant hurdle. Building new pipelines, LNG terminals, and port facilities is a massive undertaking, requiring enormous capital investment and lengthy construction timelines. Reshaping the continent. The future of North American energy interdependence. Canada's strategic energy pivot towards Asia and other global markets is poised to significantly reshape the long-standing energy dynamics of North America. For decades, the continent operated as a relatively integrated energy system, with Canada as a primary supplier to the energy-hungry United States. As Canada actively seeks to diversify its customer base, this traditional relationship will undoubtedly evolve. While the U.S. will likely remain a key market for Canadian energy for the foreseeable future, its overwhelming dominance is set to diminish. The development of Canadian LNG export capacity introduces a new dimension to North American energy flows. Canada will increasingly compete with U.S. LNG exporters in global markets, especially in Asia. This could lead to both competitive pressures and opportunities for collaboration in areas like technology development and market intelligence. Ultimately, Canada's energy pivot is a quest for greater economic self-determination and resilience in a rapidly changing global energy world.